The purpose of this video is to introduce you to how we account for accounting changes and how error analysis is performed under GAAP. So the first thing I'll show you right here is in overall summary, this is how we account for these things. If we have a change in accounting principle, we will apply that change retrospectively. So in other words, we will go back to previous periods and change the information as if that accounting principle had been used. If it's a change in accounting estimate, the way we handle it is current and prospectively. So we will not go back and change any financial statements from the past, but we will update the new information, the financial statements based on the new information for the current period and for future periods. And then if we have a change in reporting entity, such as when companies merge or a different entity reporting requirement, then we would apply it retrospectively as if the company existed as such in the past. So these three are the categories that are considered accounting changes. And then for any errors that we find, those errors are corrected retrospectively to previous financial statements. And of course, we're talking about material amounts, as it's always the case with GAAP. We deal with these things for material amounts. So let's look a little bit further into this. When we are talking about change in accounting principle, the first one here, we did say it's retrospectively applied. And when do we do this? Well, if we have a principle that is preferable, and that can be a little tricky sometimes, but if we deem it to improve financial reporting versus a different method that we have been using, then that's when we apply this new accounting principle. So some examples might be, if you're dealing with long-term contracts, you could have the completed contract method that recognizes revenue upon finishing the long-term contract, and you may change to the percentage of completion, where you are allowed to recognize partial revenue as the long-term contract is being completed. So that would be an example of a change in accounting principle. Also FIFO, if you're using FIFO and all of a sudden you want to use LIFO, that's a change in accounting principle as well. And as I mentioned a second ago, the idea of what's preferable, it's not always easy to determine. There's a lot of judgment involved in that. But if we have a scenario where the FASB issues a new pronouncement or updates information and states that there's a particular method that is preferred, then that's not difficult at that point because they have deemed, the FASB has deemed that that is the preferable method. But when it is a decision of the company itself, that's a little trickier. Okay, so what do we do when we have this scenario? We will apply the changes retroactively for direct effects. So that's interesting to think about. There are things that we change on the financial statements that are affected directly. These are the accounts themselves that are affected versus things that are indirect. So you might have a bonus or some form of compensation that is based on net income. Of course, if we change the accounting principle, it might change net income, which is the direct effect. You know, it might change an expense account or an asset account, things of that nature. Those would be considered direct effects. But then it might also change net income, which indirectly affects other things. So we'll talk a little bit about the indirect in a minute, but for now, let's focus on the direct effects. For those direct effects, we will change prior year financial statements as if we had used that accounting principle in the past. And then we will note the cumulative effect by adjusting the beginning retained earnings for the earliest period that we presented. So if we're presenting comparative financial statements, we would adjust the retained earnings for the earliest period that is presented to the public. Okay? And the idea there is anytime we apply these changes retrospectively, we are hoping to improve comparability for somebody that's looking at these financial statements. If they have to look at several periods, it helps if the application of that accounting principle is demonstrated as if it had occurred for all those periods, so that the average financial statement user can look at it and be able to compare it. Now, besides the accounting that you have to do, we also have to disclose three things: the reason why we're doing that change, what's the nature of that change, and the effect on key performance indicators such as net income or others. And then, like I described a minute ago here, the cumulative effect on retained earnings. All right, so that's the accounting. Of special note is the fact that if it's impractical for us to apply this retrospectively, then the rules allow for prospective treatment or prospective accounting for it. Okay, and you may ask yourself, what does impractical mean? Well, if one of these three scenarios applies, then we can deem it to be impractical to be able to apply the changes retrospectively, and instead we would apply them prospectively. The first one is if you cannot determine the retrospective effects. Maybe it's very difficult to determine that. So if you cannot, then there's no option. If it requires you to come up with assumptions that were made in the past about the intent, of course that is very difficult because we don't know what the intent was or the assumptions behind those intents in the past were. So if it requires us to do that, then we would deem it impractical to apply this retrospectively. And if it requires us to come up with some significant estimates for a prior period that cannot be objectively verified, then we would also deem it to be impractical. Okay, so you can think of this as an exception to the retrospective application. If the exception applies, then we do it prospectively. And then regarding what I mentioned a few minutes ago here, that the retrospective application is for direct effects. If you have indirect effects, okay, these are secondary affected items like what I mentioned a second ago about a bonus. Let me correct the the typo here. A bonus based on the direct effects, then the application for those changes are done currently. All right. So if for some reason you're going to increase the bonus because of the fact that income changed due to that change in accounting principle, that change in bonus or that additional amount in bonus is applied only to the current period. All right, the next category is a change in estimate. And with the change in estimate, the application is during the current period and prospectively. And this involves just regular changes based on events that occur, new events that occur. And they're deemed to be normal recurring adjustments, okay? So if for some reason you had a particular amount as an estimate of residual value or salvage value for your equipment, and all of a sudden that changes, that's not necessarily an error or an issue dealing with an accounting principle. That's just a change in estimate, and we will readjust the depreciation based on that new set of information. Now, what's interesting is that if you have an issue where something is possibly a change in accounting principle or a change in estimate, okay, and it's hard to distinguish this. So in other words, you are going back and forth between whether something you're doing is a change in an accounting principle or an estimate. The rules say just treat it prospectively as a change in estimate. Okay, so what's an example of that? A change in depreciation method. Sometimes we use declining balance depreciation methods at the beginning of an asset and then eventually transition to straight line depreciation. So even though that's changing in accounting principle, we deem it more a change in estimate based on new information. Now, don't confuse that with what I just described here regarding a change in the residual value. That's clearly a change in estimate, okay, when new information comes up. But this is not necessarily about new information. This is simply a change from declining balance to straight line or something similar. And since it's hard to break apart whether it's really a change in estimate or an accounting principle, then at that point we just treat it as if it were just a change in estimate. And then the third category here for changes is a change in reporting entity. And again, this is applied retrospectively. We change all the financial statements from prior periods and report it with the financial information of the new entity. So in other words, you will look at financial statements from the past as if those companies were together. So if you had a financial statement that in the past was reported for a subsidiary or a particular company on its own, now when we report those previous periods, it's going to not be that firm alone. It'll be the combined information. Now, finally, we have accounting errors. And with accounting errors, we're going to apply this retrospectively as well. We will report any prior period adjustments to retained earnings. And similarly to what we said before in terms of how we deal with accounting changes in accounting principles, same thing here. We will adjust retained earnings to the earliest period presented. And the idea is we're trying to show financial statements as if the error had never occurred. So obviously retained earnings needs to be adjusted because any expenses or revenues would have been closed. So what are some examples? Maybe you were applying some rule incorrectly and you went from non-GAAP to GAAP. You made a math error or an error in estimates, anything of that nature. And you'll have to recreate the information to correct those previous periods. So in conclusion, we have 3 accounting changes and 1 error, right? Or 1 classification for errors. And in general, pretty much everything's done retrospectively except with the accounting estimates. That is not necessarily a change to the past, but going forward.